Hello, everyone. Welcome to the market opening bell for Tuesday, August 5th, your 10-minute guide to the stock market. With markets anticipating U.S. interest rate cuts, Hong Kong stocks rebounded on Monday after 4 days of declines. The Hang Seng Index opened 75 points lower, briefly fell 135 points to 24,372, then climbed, peaking at 24,748 with a 240-point gain and closed up 225 points or 0.9% at 24,733. The H-share index rose 89 points or 1% to 8,893, while the Hang Seng Tech Index gained 83 points or 1.6% to 5,481. Market turnover total 234.6 billion Hong Kong dollars, down from 254.6 billion the previous day. Southbound trading reached 130 billion, but southbound funds saw a net outflow of 18.092 billion, compared to a net inflow of 12.207 billion last Friday, marking the largest net outflow since May 12, when it was 18.528 billion. Net buys included Alibaba at 728 million, InnoScience at 362 million, Kuaishou at 219 million, and SMIC at 217 million. Net sales were led by the Tracker Fund at 14.53 billion, HSCI ETF at 6.326 billion, Hang Seng Tech ETF at 1.453 billion, Akasol at 323 million, UB Tech at 242 million, and Guotai Junan International at 191 million. Southbound funds have consistently bought Tencent for 8 days, totaling 3.594 billion, and Xiaomi for 7 days, totaling 4.162 billion. Technically, the Hang Seng Index reached 24,748 but couldn't break the 20-day moving average of 24,792. Turnover was lower than Friday's 254.6 billion, and the 9-day RSI stayed below 50 at 46.4. This suggests the rebound is a technical recovery after a 4-day drop of 1,054 points. A stronger signal of adjustment ending would be filling the gap between 25,082 and 25,000 from last Thursday's decline. In A-shares, the major indexes opened lower but closed higher. The Shanghai Composite rose 23 points or 0.7% to 3,583, and the Shenzhen Component gained 50 points or 0.5% to 11,041. Total turnover in Shanghai and Shenzhen was 1.4986 trillion yuan, down 99.7 billion yuan from the prior day. The renminbi-US dollar central parity rate increased by 101 points to 7.1395, the largest rise since January 21st. In Hong Kong, Tencent climbed 2.8% to 550 Hong Kong dollars, boosted by its mobile game Valorant Source, set to launch on August 19th, with 60 million pre-registrations, according to Chinese media. The PC version of Valorant is a leading global shooting game with 5 to 6 million daily active users and ranks among the top 5 esports titles by viewership. Developed by The PC version of Valorant is a leading global shooting game with 5 to 6 million daily active users and ranks among the top 5 esports titles by viewership. Developed by Tencent's Riot Games, the mobile version, a key 2025 release, arrived earlier than the expected November launch, easing concerns about last May's high base from Dungeon and Fighter Mobile. Analysts predict annual revenue of 5 to 6 billion yuan. Coal stocks rallied as China's Sanhua's parent, National Energy Investment Group, launched a 100 billion level asset injection plan. This is expected to enhance China's Sanhua's coal reserves and operational integration, strengthening its energy industry chain. Analysts see this as a shift in the coal sector toward consolidation, with leading firms using resource, logistics, and capital advantages to dominate through acquisitions, potentially stabilizing coal prices. Banking stocks performed strongly, with Agricultural Bank up over 3%. ICBC China Merchants Bank, Minsheng Bank, and Chongqing Bank up over 2%, and CCB, CITIC Bank, and Everbright Bank up over 1%. By July 31st, five Asia-listed city and rural commercial banks, Qingdao, Qilu, Ningbo, Hangzhou, and Changshu reported positive growth in revenue and net profits for the first half, with stable asset quality. Net interest margins benefited from lower liability costs and larger deposit rate cuts compared to loans, with 2025 declines expected to be less severe than in 2024. CLP Holdings reported its first half 2025 results with net profit down 5.5% to 5.624 billion Hong Kong dollars and earnings per share at $2.23. It declared a second interim dividend of $0.63 per share, unchanged from the first interim and last year. Revenue fell 2.8% to $42.854 billion due to lower Energy Australia customer business revenue. Operating profit before fair value changes dropped 8% to $5.227 billion, driven by weaker Energy Australia retail performance and reduced contributions from mainland China's nuclear and renewable assets, partially offset by strong Hong Kong results. Hong Kong energy business profit grew 7.3% to $4.469 billion, while mainland China profit fell 11.9% to $870 million. Australia dropped 72.7% to $167 million. India fell 61.1% to $79 million, and Thailand plunged 75.9% to $19 million. Companies announcing results today include TTI, Yum China, China Tower, and Fortune REIT. TTI expects first half revenue and net profit to rise 8% and 17% respectively, outperforming peer Stanley Black & Decker. Stanley's second quarter results slightly missed expectations, but it raised its adjusted earnings per share guidance from $4.5 to $4.65, benefiting from China tariff cuts from 145% to 30%. Stanley plans to reduce China production capacity to under 5% by next year, while TTI's shift to Vietnam and Mexico is expected to accelerate, potentially capturing more market share. U.S. markets rebounded sharply on Monday. The Dow rose 585 points or 1.3% to 44,173, recovering Friday's losses. The S&P 500 gained 91 points or 1.5% to 6,329, ending a four-day decline with its best performance since May. The Nasdaq climbed 403 points or 2% to 21,053. The Nasdaq Golden Dragon China Index rose 97 points or 1.3% to 7,424. Among the Magnificent Seven, Nvidia, Meta, and Alphabet rose over 3%. Tesla gained 2.2% with plans to grant CEO Elon Musk $29 billion in stock awards, though its China-made EV sales fell 8.4% year-on-year in July due to competitive pricing, reversing June's light growth. According to PCA data, Amazon was the weakest, down 1.4%. Spotify surged 5% after announcing premium subscription price hikes in some markets. Palantir reported second quarter revenue of $1 billion, up 48% year-on-year and 14% quarter-on-quarter, beating estimates of $940 million. Adjusted earnings per share was $0.16, above the expected $0.14. Its stock rose 4% after hours, with full-year revenue guidance raised to $4.142 to $4.15 billion, up from $3.89 to $3.9 billion. Our stock pick today is Sanhua Intelligent Controls, stock code 2050. Sanhua Intelligent Controls focuses on the research, promotion, and application of thermal management technology, providing energy-efficient solutions for clients. Its business spans two major segments: refrigeration and air conditioning components and automotive components, while also pursuing global operations and expanding into emerging fields such as bionic robot, electromechanical actuators. As of December 31st, 2024, the group operates 48 production facilities worldwide, including 13 overseas factories in the United States, Poland, Mexico, Turkey, Austria, Vietnam, Thailand, and India. Based on 2024 revenue, the group is the world's largest manufacturer of refrigeration and AC control components and the fifth largest manufacturer of automotive thermal management system components, with market shares of 45.5% in the global refrigeration and AC control components market and 4.1% in the global automotive thermal management system components market. The group's core focus is on the development and application of heat pump technology and thermal management systems, specializing in environmental thermal management solutions that achieve efficient heat exchange and intelligent temperature control. In the refrigeration and AC component segment, the group primarily engages in the development and application of control components, subsystems, and technical solutions, enabling high-performance building HVAC systems and home appliance thermal management systems. It is a key supplier of refrigeration and AC control components for markets including household AC, commercial refrigeration, industrial refrigeration, and small appliances with products covering valves, heat exchangers, pumps, and controllers. In the automotive sector, the group is dedicated to providing essential integrated thermal management control solutions for new energy vehicles, while offering high-performance, energy-saving, and emission-reducing products for traditional internal combustion engine vehicles. The group actively participates in the R&D of valves, pumps, heat exchangers, and integrated components, particularly for cabin thermal management, battery thermal management, and motor electronic control system thermal management, aiming to achieve effective thermal management in vehicle operations. In strategic emerging businesses, the group leverages its expertise in motor manufacturing, economies of scale, and cost control to successfully enter the field of bionic robot electromechanical actuator manufacturing. Through independent innovation, it provides lighter, smaller, and more precise electromechanical actuator products. Over the past years, the group's performance has grown steadily. Revenue increased from 21.347 billion yuan in 2022 to 24.557 billion yuan in 2023 and further to 27.947 billion yuan in 2024. Profit rose from 2.608 billion yuan in 2022 to 2.933 billion yuan in 2023 and then to 3.111 billion yuan in 2024. Recommended buy price 25.8 Hong Kong dollars, target price $28, stop loss $24.5. I do not hold the aforementioned stock.